You are staring at a massive growth opportunity, but there is a heavy piece of machinery, a fleet of delivery vehicles, or a vital software upgrade standing directly between you and that next level of revenue. Purchasing these assets outright requires a massive capital outlay, forcing you to choose between completely draining your hard-earned reserves or walking away from a lucrative expansion. This is the classic frustrating dilemma of scaling a business, where the cost of entry threatens to suffocate the very growth you are trying to achieve. Equipment financing serves as the strategic bridge across that perilous gap, allowing you to acquire the exact tools you need without crippling your balance sheet in the process. By leveraging the value of the asset itself, you can unlock immediate productivity gains and take on larger contracts while keeping your cash safely tucked away in the bank. This is precisely how ambitious, forward-thinking businesses turn operational bottlenecks into powerful, self-sustaining engines for long-term revenue generation. At its core, this specialized funding method utilizes the machinery or technology you are purchasing as collateral. Collateral is simply an asset pledged as security for the repayment of a loan, meaning the lender has a tangible safety net if things happen to go wrong. Because the physical asset backs the agreement and holds intrinsic resale value, lenders face significantly lower risk, which directly translates to more accessible approvals and highly favorable terms for your growing business. Securing that critical machinery through financing fundamentally protects and preserves your working capital. Working capital is the money available to meet your current, short-term obligations and fund your day-to-day operations, including essential functions like payroll, inventory management, and marketing. When you deliberately avoid tying up hundreds of thousands of dollars in a single forklift or server rack, you maintain the vital agility required to handle unexpected expenses or immediately jump on sudden, lucrative market opportunities. When exploring your specific options, the financial landscape generally divides into two primary categories, which are equipment loans and equipment leases. An equipment loan functions as a straightforward, traditional path to ownership, where you borrow money to buy the asset, make regular monthly payments, and own it entirely once the debt is fully cleared. This specific route is absolutely ideal for heavy machinery, agricultural equipment, or durable commercial goods that retain significant operational value over a very long lifespan. Conversely, an equipment lease operates much like a long-term rental agreement, allowing you to use the asset for a set period with a strategic option to purchase it at the end of the term. Leases are incredibly powerful tools for rapidly evolving industries where cutting-edge technology becomes functionally obsolete in just a few short years. You get the latest medical devices or advanced computer networks today, with the total flexibility to upgrade when the lease expires, ensuring your business never falls behind the innovation curve. Lenders evaluating your funding application will look closely at your overall financial health, often analyzing your EBITDA during the underwriting process. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, and it serves as a remarkably clear measure of your company's overall financial performance and true cash flow potential. A strong, consistent operational history demonstrates your inherent ability to manage new debt comfortably, making you a highly attractive candidate for the most favorable funding terms available on the market. A highly common misconception in the commercial world is that you need a flawless, perfect financial history to secure these specific agreements. Because the physical asset heavily secures the transaction from the lender's perspective, business owners with less than perfect credit profiles can often still qualify for excellent funding. The inherent, undeniable value of the yellow iron, the commercial printing press, or the industrial oven you are acquiring does a massive amount of the heavy lifting during the entire underwriting process. Across the broader national economy, this strategic division of upfront costs is exactly how entire major industries maintain their unstoppable momentum. Massive construction firms, sprawling manufacturing hubs, and nationwide logistics companies rely entirely on this continuous cycle of acquiring assets while deliberately deferring the immediate financial impact. The leaders of these organizations deeply understand that waiting to save up the full purchase price means sacrificing years of potential market share to faster-moving, strategically financed competitors. The specific pathway to securing this vital capital is remarkably streamlined, especially when compared to the notoriously slow pace of traditional commercial banking. You typically only need a detailed quote from your chosen equipment vendor, a relatively simple application, and a few months of recent business bank statements to get the entire process moving forward. Many specialized lenders can issue a firm approval within 24 to 48 hours, meaning your new revenue-generating tools can literally be on the delivery truck before the current work week is out. As you review those rapid, exciting approvals, it is absolutely critical to pay very close attention to the APR. The APR, or annual percentage rate, represents the true, comprehensive yearly cost of borrowed funds, including the base interest rate and any associated origination fees. Understanding this exact, all-encompassing figure allows you to accurately and confidently calculate the real cost of the financing against the projected real-world revenue the new asset will undeniably generate for your company. Aligning the comprehensive cost of the APR with your projected revenue increases is the ultimate foolproof safeguard against dangerous over-leveraging. If a brand new commercial packaging machine costs $2,000 a month to finance but generates $10,000 a month in entirely new production capacity, the physical asset effectively pays for itself immediately. You are not taking on a heavy financial burden. You are strategically acquiring a self-funding revenue generator that instantly boosts your bottom line. Beyond the immediate, obvious cash flow advantages, acquiring machinery through these methods often unlocks truly substantial and lucrative tax benefits. Under Section 179 of the IRS tax code, businesses can often deduct the full, total purchase price of qualifying equipment in the exact year it is placed into service, even if the asset is completely financed. This massive government-backed deduction can significantly lower your overall taxable income, effectively letting the tax code heavily subsidize a major portion of your vital business expansion. While a traditional SBA loan offers incredibly low rates and very long terms for major, multifaceted business expansions, the exhaustive underwriting process can easily take several months to complete. If your primary commercial refrigerator suddenly breaks down, or if you unexpectedly win a massive contract that requires immediate logistical fulfillment, you simply do not have months to wait. Dedicated equipment funding steps perfectly into this critical void, aggressively prioritizing transaction speed and asset value over exhaustive, slow-moving bureaucratic reviews. As you consistently integrate these powerful financial tools into your operations, your fundamental perspective on operational growth begins to radically shift. You permanently stop viewing large physical purchases as terrifying, risky capital drains and start seeing them as highly calculated, manageable monthly investments. This profound evolution in executive thinking directly empowers you to confidently bid on much larger contracts and aggressively pursue entirely new markets, fully knowing you have the financial mechanisms ready to scale your infrastructure on demand. It is absolutely crucial to match the right financial product to the right operational need to ensure long-term stability. If you desperately need to cover payroll during an unexpected slow season, invoice factoring or a merchant cash advance might provide the necessary, rapid short-term liquidity to survive. However, using those specific short-term, higher-cost products to buy a $50,000 agricultural tractor is a severe strategic mismatch. Acquiring long-term assets fundamentally requires long-term, asset-backed financing to maintain healthy margins. A dedicated line of credit is another truly excellent financial tool for smoothly managing ongoing, unpredictable operational expenses or effectively bridging seasonal cash flow gaps. Yet deliberately preserving that valuable credit line for unexpected urgent emergencies while utilizing dedicated equipment funding for heavy machinery is an absolute masterclass in corporate capital allocation. You keep your highly flexible emergency funds completely intact while still putting brand new, powerful, revenue-generating tools directly onto the active warehouse floor. Consider the profound transformative impact of a newly financed fleet of modern delivery vans on a growing regional distributor. That initial capital, once confidently secured, became the unbreakable foundation for doubling their effective delivery radius and capturing a completely new, highly profitable demographic. The manageable monthly payments were easily and quickly absorbed by the massive influx of new daily orders, definitively proving that the right physical asset, financed correctly, is an undeniable catalyst for exponential corporate growth. Furthermore, strategically financing physical assets in a fluctuating, unpredictable economy naturally acts as a highly powerful, built-in hedge against rising inflation. You securely lock in your exact purchase price and your strict monthly payment structure today, but you strategically pay off the remaining balance using tomorrow's progressively inflated, less valuable dollars. Meanwhile, the heavy machinery is actively, continuously generating real revenue at current, elevated market rates, creating a highly favorable and deeply profitable economic dynamic for your long-term bottom line. The positive echoes of those early strategic financial decisions will continuously resonate throughout the entire future life cycle of your expanding company. When you finally master the nuanced art of acquiring vital assets without dangerously depleting your cash reserves, you inherently build a highly resilient, aggressively competitive enterprise. Your industry competitors will constantly wonder exactly how you afford to continuously upgrade your facilities, remaining completely unaware of the brilliant strategic financing engine quietly powering your daily operations. This specific financial dynamic is exactly what enables ambitious small businesses to successfully punch far above their weight class and directly compete with massive, entrenched corporations. By intelligently utilizing the exact same sophisticated financial leverage that Fortune 500 companies use every single day, you effectively and permanently level the competitive playing field. You gain immediate access to the exact same high-end robotics, the same advanced software suites, and the same heavy-duty logistics equipment, all without ever needing a massive corporate-sized bank account. To perfectly position yourself for the absolute best possible funding terms, proactive and organized preparation remains your single greatest strategic advantage. Gather your detailed vendor quotes early. Ensure your business bank statements clearly reflect steady, reliable deposits, and carefully craft a clear narrative about exactly how the new asset will directly increase your profitability. Specialized lenders absolutely love to partner with focused business owners who can clearly and confidently articulate the straight line between the equipment purchase and vastly increased revenue. The exact moment that new cutting-edge machinery finally powers up, or that advanced new software system officially comes online, the theoretical benefits of financing become incredibly, undeniably tangible. You get to physically watch your production times sharply drop, your costly error rates plummet, and your overall operational capacity aggressively surge forward. The required monthly payment very quickly becomes a complete afterthought compared to the massive, game-changing operational advantages you have just successfully unlocked for your entire dedicated team. Your hard-working business absolutely deserves the highest quality tools necessary to fully realize its maximum potential, and temporary capital constraints should never be the permanent barrier to your ultimate success. By strategically and confidently leveraging the inherent value of the physical assets you desperately need, you can vigorously protect your cash, fully optimize your taxes, and aggressively scale your daily operations. The clear, unobstructed path to your next major business expansion is permanently built on smart, highly accessible, and perfectly timed equipment financing. If you want to see what your business qualifies for, complete the quick Brightside quiz, HTT's Brightside Capital IO Business Survey. It only takes 2 minutes, and it's a simple way to start reviewing your funding options.